What's going on, everyone? Sebastian here from Crypto News, bringing you the best crypto content on a daily basis. Today, we're going to be talking about how to effectively apply risk management strategies as a cryptocurrency trader. Now, why is that so important? Simply put, this should be one of the foundational rules for all crypto traders in the entire world to follow, simply because people need to know how to effectively apply risk management when they're entering cryptocurrency. Cryptocurrency, as you know, is very volatile, and there's not a specific class you can take to even help manage some of these risks. So while you can learn through your own experience, this video will help mitigate that loss. And so if you stick with me to the very end, you will now be much more of a professional trader when looking at the crypto markets, and hopefully should be on your way to making more profitable returns. Now remember, I am not a financial advisor, so please always do your own research anytime you're investing in cryptocurrency. This video is strictly for educational purposes only. And if this is your first time watching one of my YouTube videos, please subscribe to this channel if you want some of the best crypto content delivered directly to your phone on a daily basis. And also, please leave me a comment just to introduce yourself and let me know why you joined this channel to begin with. I love connecting with my audience, so please always feel free to share your thoughts in the comments below. The cryptocurrency market has seen very significant growth, as beautifully illustrated in 2021 updates from CoinMarketCap. We have seen the total capitalization of the cryptocurrency market exceed $1 trillion. Now, just compare that to what it was the previous year. As the market continues to grow, cryptocurrency trading has also become incredibly popular, especially among newbies coming on board with the hopes of milking the market and making consistent and profitable returns. What many of these people do not know is that the market is as risky as it is profitable. While you can double your stake in no time, you can also lose everything just like that. And so, because of the likelihood of losing money, understanding and applying risk management becomes extremely crucial. It's okay to learn from one's mistakes, but when it comes to cryptocurrency trading, that's a costly way to learn. As it is, risk management is one of the most important aspects of crypto trading. And so, before you make any move, let's quickly look at what it is and how to use it to avoid draining your entire deposit in the market. So, what is risk management? Generally, risk is all about the likelihood of a venture not turning out as planned, which can result in losses. In crypto trading, it is the possibility of losing your invested funds. Regardless of how highly profitable the cryptocurrency market is, if you have only little or even nothing to show for it, then it is an absolutely fruitless venture. That is where risk management comes in. Risk management involves predicting and controlling possible losses from unsuccessful transactions. It can often make the difference between making consistent returns and losing your capital. Note that if you keep losing money in your trades, that is because you have poor risk control skills, which translate into making impulsive decisions that won't stop until your capital is completely drained. Or let's put it this way: if you don't understand and apply risk management strategies in your trades, and you choose to trade rather intuitively, you'll most definitely end up with more losses. Having established that, what then are these risks associated with cryptocurrency? The first is market risk and price change risk. As you already know, the crypto market has high volatility, which means the prices of cryptocurrencies are unstable. They can go up, which means profits, but can also go down, resulting in losses. There's also liquidity risk. Liquidity refers to the ability of a cryptocurrency to be converted to cash on request. It's all about the ease of entering and exiting the crypto market without significant slippage. Liquidity risk, or low liquidity, comes up when a trader is unable or incapacitated to convert their position to fiat currencies at the desired price. This is because demand and supply are limited. Note that this is one of the factors that can lead to an abrupt change in market price. Next, there's credit risk. Credit risk is simply the chance that the parties behind a crypto project will fail to fulfill their due obligations. This kind of risk is mostly attributed to scam projects, where the developers only intend to steal and defraud investors in the crypto market. Next, we have legal risk. Legal risk is about the chance of something negative happening with regard to regulatory rules. For example, a particular country placing a ban on cryptocurrency trading. There's also operational risk. Operational risk refers to the possibility that a trader cannot trade, make deposits, or even withdraw funds from his or her crypto wallet. There's risk of ruins. Risk of ruins is an idea that calculates the chances of a trader losing all his or her investment capital in a single trade. This risk is directly connected to position sizing, which is a risk management strategy we'll discuss next. So now let's talk about some of the risk management strategies. There are three broad categories of risk management strategies. They are position sizing, risk reward ratio, stop loss, and take profit. Position sizing simply refers to the volume of a specific transaction and trade. It dictates the number of coins or tokens of cryptocurrency a trader is willing to purchase at a given time. The idea behind this strategy is that you shouldn't put all of your eggs in one basket, risking it all on one trade. The general rule of thumb has always been to trade with only what you can afford to lose. However, because there are chances of making huge profits in crypto trading, crypto traders often allow their emotions rather than serious calculations and logic to guide their actions. There's often this fear of missing out, FOMO, that tempts them to put in up to 30 or 50 or even their entire trading capital in one trade. Nonetheless, this move is very disruptive and puts you at serious financial risk. If a trade doesn't work out in your favor, you risk blowing up your account and drastically reducing your capital balance. But if you trade with a fixed percent of your balance, for instance 1% or no more than 2%, you get the chance to adequately manage your risk as you get to focus on generating consistent returns instead of worrying about losing everything. This means with just a little amount of your capital at stake, any miscalculated move only costs you a little amount. And if you stick to your strategy, you can easily cover up and make even more profit. Next, let's talk about the risk-reward ratio. The risk-reward ratio simply compares a trade's actual level of risk with the potential profits therein. Understanding the risks and reward ratio helps traders to know when to enter a trade and when there likely won't be returns. And so, a trader is far more likely to only take trades that seem more promising if he or she can adequately determine the profit they can expect from a trade as against the risk they are taking on. This means that over a period of time, a trader that has been employing this strategy should be able to generate a net return since they are only taking. Here's how to calculate the risk reward ratio. R equals target price, entry price, stop loss. So here's how to calculate the risk reward ratio. R returns equals target price and entry price and stop loss price. Ideally, it should be 1-to-3 or at least 1-to-2. If you can get anything less than a 1-to-1 risk reward ratio after your calculation, consider such trades as unfavorable. It's best not to get in. Now let's talk about stop losses and take profit targets. Stop losses are executable orders that close open positions when prices decrease to a specific barrier. It saves you from trading in unprofitable deals. On the other hand, take profits are also executable orders to liquidate open orders when prices hit a certain level. This one helps you get out of a trade before the market can turn against you. Both are good approaches to managing risk. In fact, if you are not applying any other risk management strategy, you should definitely apply this one. The absence of stop loss placement in a trade can actually be very problematic. This is evident in situations when a trader doesn't place a stop loss and when the trade turns against him. He's unwilling to close out, believing that it will rebound in their favor. Well, that can happen, but what if it doesn't until he gets liquidated? In the same way, take profit placements also saves you from eventually losing a once profitable trade. Have it in mind that greed never leads to good outcomes, so determine your take profit level in advance before entering the trade. Going forward, here are some other tips to apply to minimize your trading risks. Then it's time to take a break. Such breaks is essential to help you recover psychologically and avoid making rash decisions. Don't get overconfident. Generally, self-confidence is important in any of life's endeavors, but overconfidence isn't, especially as regards crypto trading. Overconfidence is definitely what will make a trader invest up to half or the entirety of their deposit. While you might know exactly what you are doing, it's still important to tread with caution. Deals can turn unprofitable even with the most professional forecasts, and that's why you should never feel too certain. You should understand that risks are part and parcel of crypto trading. Hence, you can't eliminate them, but you can learn to manage them. If you make losses, don't be discouraged. Accept them and cast your mind on the number of times you've made profit. This will help you to remain positive while relying on your risk management strategy to cover up losses in the future. Well, there you have it, folks. How to properly apply risk management as a crypto trader. Let me know in the comments if this was a great video to help you manage your risk effectively as a crypto trader. And if it did, please share your excitement in the comments below. And also, if there are any other risk management strategies that you've found to be useful, please, I encourage you to also share those in the comments below and let me know what your risk management strategies are. I'm an open book and I love to learn things myself, and I think the viewers will also really appreciate that. And as always, if you found this video resourceful, please smash that like button as it does help support this YouTube channel. Well, thank you so much for watching. I'll see you all on tomorrow's video.